So did you get your letter from Social Security this past week letting you know, hey, here's what your new benefit is going to be? Well, if you're like about 10%, even potentially higher of the population, you were disappointed with what that letter said because it told you that your Social Security had been impacted by Irma, not the hurricane, but rather an adjustment based upon your prior income to how much you have to pay for your Medicare premium. We're going to talk more about why that is happening, hopefully explain it to you a little bit, and also give you some hope to maybe dispute the Irma catastrophe that many Americans found when they opened up their letter from Social Security. Also, in the back half of this week's program, we're going to be joined by fellow certified financial fiduciary and CPA at Nelson Financial Planning. Kristen Cayley is going to be joining us to talk a little bit about some of the changes that are going to happen as we enter into the next tax year. Well, actually, we're in the middle of that tax year, 2022. But if you or you know somebody who does anything online in terms of buying or selling anything, whether it's cute little Christmas wreaths or concert tickets or whatever the case may be, you really want to listen to the program, particularly those portions in the back half that Kristen will be joining us on, because we've got some interesting developments and some strategies that you're going to want to certainly be aware of. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. So this past week, had the opportunity to actually attend a national FINRA conference on Thursday at the Gaylord Palms. Now, if you've never been there, let me assure you that that is a massive hotel and convention complex. And FINRA, of course, is the Financial Industry Regulatory Authority, primary regulator for financial firms, broker-dealers that are in the financial services industry. Them, along with the SEC, are kind of the two primary regulators. Anyway, this was a national in-person, actually, conference. Those are starting to kind of return, so that is good. Attended by about 300 people from all over the country, and certainly heard a lot of the latest regulations and things like that the folks in Washington are looking at from a regulatory perspective. And one of the more interesting comments, and this is why we wanted to kind of share with you some of the comments that were shared with us, have to do with what's been in the headlines of late, right? Obviously, the bankruptcy of FTX, which was a cryptocurrency exchange, is on a lot of people's mind, particularly if you're a regulator, because many investors had placed their cryptocurrency holdings with FTX, or for that matter, had placed cash with FTX in the hopes of generating a little bit more of an interest rate on those cash savings. And after all, if you are a regulator, your primary role is supposed to be protecting the American people from stuff like that. The problem is, and history kind of bears this out, is that unfortunately, by the time the regulators regulate something new, it's probably too late. There's a little bit of a reactive, if you will, approach to regulation, not necessarily a proactive. And I think this cryptocurrency and cryptocurrency exchange stuff sort of fits into that category as well, because maybe if they had come up with these rules and regulations 2 or 3 years ago, then perhaps those folks that are going to be holding the bag with FTX, cryptocurrency exchange, might have been a little bit fewer of them. Anyway, here's the interesting comment, because obviously that was on the top of mind from a regulatory perspective, beyond the fact that you take a $3 trillion sort of industry and it drops all the way down to 900 billion within a few month period of time. But the head of member supervision was talking. It was kind of one of the initial sessions, and happens to be a former FBI agent, and he worked the Enron investigation. And so remember that was, pretty significant unraveling of a major corporation in America back, when was that? Probably 12 years or so ago. Anyway, his comment, which is what we wanted to kind of share with our listening audience this morning, is that they're seeing a lot of parallels. And unfortunately, they think that the scope of this one may even be greater than what they saw with Enron. So anyway, a little perspective, if you will, on some of those headlines directly from the folks that are in the business of regulating and sort of uncovering exactly what went on. So expect sort of the headlines there to get, unfortunately, much worse than what they have been. Also, this past week, and Thursday and Friday weren't particularly great days for the market, but Wednesday was, because our good friend Jerome Powell got in front of a microphone and said, hey, we think we're only going to raise rates a half a percentage point and not 0.75 of a percentage point. That spurred the market up about 700 points on Wednesday. And the reason why I want to kind of focus on that particular day, which we don't necessarily focus on one day in the market versus another typically, but it was interesting because if you saw some of the headlines, the Dow actually crossed a particular threshold. And so the headlines were reading that the Dow was now back in a bull market. And so you may be wondering, if you saw those headlines, like, how on earth can that be happening? Because it has been sort of a tough year. And I guess it starts with understanding the definition of what we're talking about, right? So a bull market is basically defined as a 20% increase. So from a low point and then on up, do the math, and if it's 20%, then that meets the technical definition of a bull market. So with the market's movement on Wednesday, the Dow, spurred of course by Jerome Powell's comments, the Dow now technically in a bull market. That's the good news. Of course, reality is that the much broader market index is the S&P 500, still down 14% for the year on course, or at least through Wednesday, down 14% through the course of the year so far, still on pace for the worst year in terms of performance since 2008. The NASDAQ, which is more the tech-heavy companies, those are down. That index is down almost 27%. Through the middle of this week, on the day that the Dow sort of crossed back into that bull market territory. So the fact of the matter is, Dow is up 20% since basically September 30th. It actually happens to be the best 2-month gain of the Dow since July of 1938. So some pretty dramatic movements. We've got 3 observations about this particular movement, particularly as it relates to the Dow. And we want to share those with you, and we will do that when we come back here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the Dow being in a bull market, a threshold that was crossed this past Wednesday. If you saw the headlines, then that was certainly the conversation. All of that really means is that it met the technical definition of what a bull market is, which is that it's up 20% since a prior low point. Unfortunately, the broader base market, not anywhere near close to that. S&P 500 still down about 15% year to date. The tech-heavy NASDAQ down even more than that, 28%. Interesting conversation, though, about the Dow. If you saw those headlines as a result of its movement on Wednesday, the best 2-month percent gain for the Dow since July of 1938. I think that comes with, I said 3 observations before the break. I'm actually going to add in a 4th one, and these would be the observations of that. Number 1, larger conglomerates, big giant brand names, which would be what exactly the Dow is made up of. Remember, that's only 30 different companies, and you've got to meet certain parameters in order to become a member of the Dow. Larger companies continue to show the ability to navigate through tough economic times. That's a contention that we've been making on this program for 30 years, and the reality is it certainly continues to bear itself out. So that's number one. Number two, guess what? Bull markets follow bear markets. That's always sort of the case. And bear markets follow bull markets. That's the cycle, if you will. So not surprising that there isn't a bull market following the bear market that we've seen earlier this year, but perhaps surprising about it being that narrow, at least at this point, and that it is just related to the Dow, number one. And number two, obviously, that is the pattern. The broader markets haven't necessarily seen that. Number three, I think we're up to number three. It can happen quickly. And I think this is the part that people miss, is that you only hear about the market declining rapidly. The media does a good job about really not talking about some of the more positive things that happen out there, particularly when it comes to market behavior. So not only can the market go down quickly, it can also go up quickly, hence sort of eliminating the notion that you're going to be able to time the market, especially when it moves as rapidly as it does, which of course gets us to the final observation, and that is volatility. Well, we typically say volatility loves company, and it certainly does, but volatility has two parts, up and down. So anytime you talk volatility, okay, it can be that things are going down, but it also can mean that things are going up. And a lot of the market's best days or best performance in short periods of time is in fact clustered around those periods of times when the market is having its worst days. Again, underscoring the impossibility of trying to time the market. So anyway, welcome to the program. This course is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So whatever your podcast channel of choice, iTunes, Spotify, even our YouTube channel, if you like to kind of watch it on video, all of that is readily available on any of those platforms. When you're on one of those platforms and you find us, simply subscribe, and then that way you will get notified as to when we're putting new content up on those platforms. If you have any trouble finding us, go to our website, nelsonfinancialplanning.com, upper right-hand corner, bunch of icons, and you will just simply click on the one that looks most familiar, and poof, you'll get automatically, assuming you have a good Wi-Fi or internet connection, automatically connected to the channel on that particular choice. My name, Joel Garris, certified financial planner, certified financial fiduciary, Nelson Financial Planning, where our team of certified financial fiduciaries, we're actually going to be joined by one of them later on in the program, talking about some of these new tax changes that have to deal with folks that sell tickets or Christmas wreaths or goods on any of these websites, or simply exchange money through cash apps like Venmo. We're going to be talking about that later on in the program. Our team of certified financial fiduciaries ready this week to help you change your life and improve it to create a more successful and cost-effective financial plan. Anyway, so this past week, you got your letter from Social Security, right? Very exciting stuff. You got an 8.7% increase, feeling very flush, if you will, with cash. Maybe not so, because these COLA increases on Social Security really have been lagging pretty significantly for many years now. But at least, hey, you got 8.7. Or did you? Did that letter surprise you? Did Irma come through and blow out some of your increase in your Social Security? Well, for about 1 in 10 Americans, it did. We fielded certainly a number of calls at the office this past week with people that got these letters that said, why is my Social Security going down? I thought it was going up. And it's certainly not a pleasant surprise. The reason is IRMA. Think IRMA with an extra A on the end. What that stands for is income-related monthly adjustment amount, otherwise known as means testing. Familiar with the concept of means testing? If you make above a certain level of income, if you have, i.e., you have the means, then you're going to pay more. And you're going to pay more on your Medicare premium. That's how it works. This started in the year 2007 on Medicare Part B. Medicare Part D joined it in 2011. It looks at your income and determines exactly where you are going to fall in terms of the additional amount of money that you're going to have to pay. And it is a cliff determination, meaning that it is not a sliding scale. If you're $1 over the thresholds, then you're going to have to pay the extra amount on that Medicare premium. For example, for a married couple, if you're over $194,000, then it's an extra $65 on your Part B and an extra $12.20 on your Part D. If you are over 246 but less than 306, then it's an extra $164.80 on your Medicare Part B per month, $31.50 per month on your Part D. So for a couple, because these are per person, it would be a total of $392.60 per month. If you fell into that particular bracket, times 12, it's about $4,700 extra per month that you will pay for Medicare Part B and Part D if you click that $246,000 threshold. Now, you may say, well, I can't imagine I'm going to click it, trip that threshold. But the issue is that people sometimes do, and it's because of those one-off transactions. And let's be very clear, one-off transactions. Let's say you sold a property, you sold a rental property, or you inherited some money and had to report some of that inheritance as income on your tax return. The IRS doesn't care that that was a one-time event. They're looking at your income and determining precisely, hey, you tripped the threshold, you have the means to pay more, so you're going to pay more on your Medicare premiums, whether it's Part B or Part D. Now, the other part that always kind of throws people off is they're looking at, like, everybody says they're looking at 2 years in the past, but it's not really kind of how that works because, see, they send you this letter in December of, like, now, 2022. Well, and to determine what your Social Security is going to be starting in January 2023, or what you're going to have to pay for your Medicare premiums, the most recent completed tax return that is on file, given this timing, would be your 2021 tax return, right? So they're looking at your 2021 tax return. Yes, it impacts your income in the year 2023, so it seems like it's a 2-year lag, but it's not really a 2-year lag because they have to look at the most recent completed tax return. And that's what triggers it, is they're looking exclusively at the completed tax return. When we get back, we're going to take a break. When we get back, I'm going to tell you the situations where there are ways to challenge this. And perhaps you can be successful at avoiding that reduction or that increase in your Medicare premiums. Plus, we're going to be joined by fellow certified financial fiduciary Kristen Cayley here in the next segment, coming up on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about Irma blowing through and taking away your Social Security, not the hurricane, but rather the income-related monthly adjustment amount that 1 out of 10 Americans saw in the letter that they got from Social Security just this past week. Thought you were getting an 8.7% increase. Fantastic. Until you trip some means testing, i.e. you had the means to pay more, so you're going to pay more thresholds that are imposed by the folks at Social Security. We were talking about that at length in the previous segment as to what the thresholds were and how much that can add. certainly can add a tremendous amount of money each and every month, because for a married couple, if you trip the threshold, it's not just one person's Medicare Part B and Medicare Part D premiums that are subject to that upward adjustment. It's both of you. So it doubles up the impact, particularly in a married couple. Now, we said that there were ways that you might be able to successfully challenge. One of the ways in which you will be unsuccessful is if you say, well, I sold the property and I'm never going to do that again, or I inherited money and I'm never going to do that again. No, that doesn't work, okay? The IRS doesn't look at that as an option for you to challenge their determination. Here are the options that you could explore to file with them to challenge that. You got married, you got divorced, you became a widow, you stopped working. Now that could be, that one could be the one that might get you if you retired. You lost income from an income-producing property due to a disaster, like a natural disaster kind of thing. You experienced a termination or reorg of an employer pension plan, or you received a settlement from an employer because of an employer's closure or bankruptcy or whatnot. That's it. That's the 7 different options that you would have. You've got to fit one of those boxes. And in order to make that claim, you need to do a form SSA-44, and ultimately that then becomes the way to try and claim that, hey, wait a minute, you hit me with this, but my situation really changed, and please don't increase the cost of my Medicare. So that's ultimately how you do it. When you file the form, you've got to go through a process of providing evidence and proof to make sure that you submit all of that. So anyway, that's the rest of the conversation on IRMAA and how those increases on your Medicare Part B, Part D premiums based upon your income in the year 2021 can certainly impact you. It's now my pleasure to welcome into the program Kristen Cayley. How are you?
I'm doing good, Joel. How are you?
I am doing good. You've been pretty busy of late. You haven't had the opportunity to join us. Why is that?
It's been a couple weeks.
Yeah, but really you've been working hard for a couple of months or so on something. What is that you've been working so diligently on?
So a couple weeks ago, I passed the CFP exam. So now just tentatively waiting for my official results.
We got to hit the applause button.
Thank you.
That is good stuff. So waiting on, so you have to clear the background check.
Exactly. Pretty much.
So hopefully you're able to clear the back. I think you will. So congratulations on that.
Yes, thank you.
Really good stuff. Becoming a certified financial planner is certainly a big achievement. So good stuff.
Thank you.
So on the program, we're going to talk about some of these changes that happened, particularly for this year. And one of the things that we do, and hopefully our listening audience appreciates the fact that we do a little prep ahead of time for these programs. It's not like we just sit in here and wing it. Although back in the day, I used to, but it wasn't as good of a show, or at least I didn't think it was a good. Anyway, so I was looking through kind of the outline notes, and I was getting more and more fired up on some of this stuff. So tell me about these changes that are happening on 1099-K reporting.
So that's one of the big ones for this upcoming tax year, is that the 1099-K reporting requirements have changed. So all third-party vendors such as Venmo, Cash App, PayPal, apps like that, they must now report payments of more than $600 for any sort of payment you receive for goods and services. And that's going to come to you in the form of a 1099-K by January 31st. So this is different because it used to be, the old rule was over 200 transactions or $20,000 worth of services or goods.
So that's a pretty significant change.
Mm-hmm.
I mean, you don't have to sell a whole lot to crack $600 in terms of, and they're talking about the gross sales price. So
Correct.
It's not like the net. I mean, it is and then that's going to automatically generate out a a 1099-K. Now, if I remember correctly, wasn't this all part of the American Rescue Plan of 2021?
Mm-hmm. So it's kind of been a work in progress. The IRS has been trying to catch people for this for years and years and years. This is just kind of the first step towards implementing some of these strategies.
Right. But wasn't that piece of legislation, didn't that have to deal with COVID and rescuing us from COVID? So,
it did.
now they're going to be taxing us on all of these types of transactions that previously really weren't kind of getting into that tax bracket. Mm-hmm. Okay. And plus 80,000 new agents.
That as well.
Okay. So what's their thought behind that? I understand some of the thought, and I get it, but what's their thought behind that?
So they're really trying to catch fraud. So people purposely excluding income because it's not on a tax form. So independent contractors, many times they don't get a W-2 or a tax form because they're paid small amounts consistently, different vendors, that sort of thing. So they're trying to catch those types of people that haven't been reporting.
Yeah, I mean, it seems to me that that's going to certainly pick up more and more people, but the whole concept of this tax gap and collecting tax revenue from people who don't pay taxes, that was sold, if you will, as something that was going to be more about, all those upper income rich people, they're all cheating. Mm-hmm. So we're going to go after them and use this as a mechanism. But the reality is that when we stop and think about who's getting paid through these cash apps, it's your babysitter,
mm-hmm. Small businesses.
It's your cleaning lady, right. It's your handyman, and I mean, there's two different impacts on this. So not only are you the receiver going to have to put it on your tax return and sort of go through the calculation, but if you are the payer, wouldn't I have to pay self-employment tax if I'm paying a babysitter, or if I'm paying anybody that a cleaning person? I mean, any of those people. Doesn't the obligation also come back to me potentially as well?
Mm-hmm. In certain circumstances, yes, it does.
So I guess both the giver and the receiver of these is going to be pretty dramatic. How much of this do they say is going to? How much money are they going to get from all this?
They're estimating $8.4 billion.
Okay, well, I guess what is that, like an hour's worth of their spending up there?
Mm-hmm.
Okay, break it down. What do I need to do? Because here's where it gets really, really confusing. How do you need to approach this?
So we've kind of identified 3 different scenarios. So let's just kind of go through the first one. So this will apply to most people. You just use these apps to receive money from friends, family, to split a dinner, vacation trips, stuff like that. So in these circumstances, that's a non-taxable transaction.
I hope so. if I go out to dinner with a buddy and he sends me back $20, okay, that's not a taxable transaction.
Right. So in those circumstances, you should not be receiving a 1099-K, but that's not to say you might accidentally receive one.
Okay, accidentally I get a tax document because how does the app how do they know at Venmo that it was for a reimbursement of a steak dinner?
They don't as of now, but they're working on it.
Okay, we got these 3 different scenarios that are pretty important. We've started on that first one. There's 2 others. We're going to take a break. When we return, we're going to talk more about this complete change to the tax approach, particularly if you do anything with a cash app. That's going to impact you. Coming up next here on Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. So do you use Venmo or any other cash app to send money maybe to the babysitter, maybe to your buddy to split a dinner? Well, this segment of the program you really need to listen up to because we've got 3 different scenarios of where this comes into play. And the reality is that if it totals more than $600, you're going to get a tax document and you're going to need to know a strategy to help address that on your taxes. So We're joined in this segment here on Dollars and Cents by one of the fellow certified financial fiduciaries and soon to be, I guess, an official certified financial planner once you clear the background check. Kristen Cayley, welcome on into the program.
Yes, thank you, Joel.
So you were breaking down the start of 3 different scenarios that where this whole 1099K thing is going to come into play. So let's reset the table on the first one.
So the first scenario is the majority of people that just use these apps for splitting payments, reimbursements, gifts to family, friends, that sort of thing.
And so in that particular case, and this is why it's so important, like in the notes, like if I Venmo somebody, they always sort of ask for, a reason for it. And it's important that now it's probably, important to fill out that reason and not make it a joke, because sometimes people do that, and make sure then that it is certainly personal, not business related.
Right. And I think when you set up accounts now, they're asking you, is this a personal account or a business account, to try and be proactive. But the past year, it's going to be kind of hit or miss depending on what your payments are for.
And the fact most people, when they set up those years ago, probably didn't select necessarily one way, or they didn't even necessarily have that option to select. And here's the problem with all of this. Okay, so let's say they make a mistake. What you get a 1099, you're like, wait a minute, that was because that was a cash gift as a wedding present, like that. What's the recourse?
So the IRS says to go directly to the payment provider. So go directly to Venmo, go directly to PayPal, and ask them to correct it. There's nothing the IRS can do about it. So you'll have to go to the payment platform. And
these online payment platforms, they have like 1-800 numbers and live people that are answering those phones 24 hours a day, 7 days a week.
I predict it's going to be pretty terrible.
I think that's a pretty fair prediction. And here's the reality is that when it comes to a tax document that has been generated by any third party, copy to you, copy also to the IRS, where's the burden of proof?
It's on the taxpayer. It's on you.
It's on you. So it is an uphill battle, whereupon you wind up having to fight an additional 80,000 IRS agents. Chances are a lot of folks are just going to throw their hands up and pay the taxes. But what can you do? Like what can you do in that situation? You tried to reach out to the company. You said, hey, this is wrong. Reissue me this tax document. And they're going to not be inclined to do that because it's a pain, because they got to send one to you and then one to the IRS as a corrected document. So then, all right, what's the alternative there?
So I think the best course of action is still to report it. So that's what the IRS says, to just report it on your tax return, but then offset it and say this is a non-taxable transaction. So when they do the automatic notices and the IRS compares your tax return to their records, they're looking for that income. So if you got $1,000 through Venmo, they want to see $1,000 on your tax return. They're not necessarily looking for the offsets. So that should be able to wipe out that $1,000 of income. But then if there is some sort of manual review of your tax return, attach a statement explaining why you offset the income.
Right. And so these statements that's going to put you more into the manual review pile. Once you attach a statement, it's not going to be electronic, and they're already behind on processing tax. Okay. So that's the first scenario. It's a gift. It was from a buddy, or it was a reimbursement from a buddy, or a gift, or whatever the case may be. Try and, number one, get it corrected at the provider level. Number two, report it and try and explain it as best as possible to the wonderful folks at the IRS. Okay, so that's scenario one. What's scenario number two?
So if you are selling things such as reselling tickets or selling furniture or old items on eBay, you'll also be receiving a 1099K if you trigger those thresholds.
Okay, so then what does that mean?
So there's kind of two different circumstances. So let's just say you bought a concert ticket, you can't go anymore, you resell it, you trigger that $600 threshold. So it's kind of a one-off sale. So that is something that will generate the tax document. You will have to report it on your tax return, but only the gain would be reported. So when you're kind of figuring out that gain, it's going to be the proceeds you received, less any sort of vendor fees or processing fees. and then less whatever you originally paid for the ticket.
So effectively a capital gain.
Exactly.
Okay. So that's great for my Taylor Swift tickets, right? Because I'm going to make a ton of money on my Taylor Swift concerts. But I also have Orlando Magic tickets. And they don't really sell at a premium these days. They you have to sell them cheap for people to go. Anyway, what happens here?
Unfortunately, if there is a loss, you cannot take the loss. You kind of just wipe out the proceeds, and you also cannot use that loss to offset other transactional gains.
Okay, this is where it gets completely insane. Okay, so you're telling me that when I sell my Magic tickets at a loss, I can't use that transaction to offset the profit that I made selling my Taylor Swift concert tickets?
Unfortunately, no.
Okay, folks. This is bizarre, to say the least. Is there any talk of the IRS issuing out some additional guidance? And I mean, this just seems. I mean, literally, I'm selling event tickets. In one case, I lose money, and I don't get to report that as a loss because it's personal property. I understand why. It would be like if I sold a couch, and I, bought the couch for $2,000, sold it for $1,000. I don't get to write that off. But then at the same point in time, I'm doing exactly the same thing, and I don't get to use that as an offset on the gain. Okay.
Unfortunately, that's where we're at.
Okay. All right. What's the third scenario?
Third scenario, so if you are actually in business, so you're using these platforms to receive payment, so kind of keep doing what you've always been doing, keep records. But just be sure that you are keeping detailed records because when you receive these 1099-Ks, you don't want to accidentally double count income.
Right. So if I'm selling on multiple platforms or people are paying me through multiple cash apps, then I need to make sure that it's not getting double counted along the way.
Exactly.
And in that case, that would be a clear business. And I think this may be where the IRS, this third scenario, was maybe the heart of what they were trying to get to, right? Because there's a lot of folks that have these sort of side businesses that I think many people, kind of do it almost as a hobby, if you will. But for those that make money, anytime you make money, the IRS wants to tax it.
Mm-hmm. Yep, they want their fair share.
See, and I think that's where it's misplaced because I think that picks up a lot of folks that are trying to work hard to pick up extra money, right? If you're making a bunch of money, chances are you're not messing around with this. So this is where my concern is that this particular tax change is going to disproportionately impact those who make less money.
I'd agree with that.
I don't think there's any way around. Combined with the fact you have the burden of proof, and I think that's the important piece is if you get any of these tax documents, to your point, Kristen, you got to report it, you got to true it up, you got to tell the story. The reality is you've got the burden of proof to do that. Mm-hmm. Anyway, we are done with the show. That was a quick one. We will be back next week. Kristen, I'm going to have you join us here another week or two to kind of talk more about some of this stuff. So thanks for listening to Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. If you love the show, check us out on our website, nelsonfinancialplanning.com.